a survival guide to a stock market crash. The near-term outlook for global markets is widely regarded as pessimistic. Experts foresee even bigger drops as a result of the current economic situation. Markets may fall even more if inflation proves to be more persistent than projected, demanding higher interest rates for longer. Furthermore, concerns regarding the consequences of the Ukrainian conflict continue. If higher interest rates keep inflation in check and geopolitical anxiety subsides, this might be excellent news for investors. Hello everyone, and welcome to another video on our channel. In today's video, we're going to discuss a survival guide to a stock market crash. So stay tuned to find out more. Now let's start our video. 1. Diversify into different sectors and countries. Funds and investment trusts, two types of collective investment vehicles, give investors immediate access to a wide portfolio of stocks and bonds. This method has less risk than investing in individual stocks. Investing in several mutual funds specializing in different regions or industries spreads risk and lowers volatility. Legendary investor Sir John Templeton remarked about diversity: "The only investors who don't need to diversify are those who are right 100% of the time. Money investment is about more than income," argues financial expert Tony Featherstone in ASX Investor Update. Diversifying your investments across asset classes is vital to decrease your exposure to any single market slump. This is critical for retirees and older investors seeking stable income and wealth. 2. Diversify into different assets. This brings us to diversifying your portfolio into bonds, real estate, and commodities, which may provide some protection in the event of a stock market crash. It is critical to select assets with uncorrelated price fluctuations, which means they rise and fall at different times and in distinct directions. As a result, if the value of one investment falls, the loss should be partially offset by gains in the value of the other investment. For example, North American equities funds generated the highest returns among this group in both 2019 and 2020. Yet, the sector as a whole has produced a negative return for the year thus far. Positive returns in commodities, infrastructure, and property funds in both 2021 and 2022 could have compensated investors for stock market losses in 2022. ETFs that track the prices and indices of specific asset groups, such as commodities, provide a low-cost way to diversify your portfolio. Except for a few ETFs in Australia, all actively strive to outperform the market. ETFs track various assets including domestic and foreign stocks, bonds, cryptocurrencies, and currencies. 3. Timing your investments. When markets are volatile or a crash is imminent, it is difficult to buy low and sell high. However, you can still do things to optimize your investment timing. Dollar cost averaging can benefit you if you invest a predetermined amount of money every month rather than all at once. If the value of a share or unit falls, an investor may utilize the proceeds to purchase more shares or units. As a result, investors often pay an average price across the full time frame. Hedging against the consequences of stock market crashes has already been demonstrated to necessitate a long-term, at least 10-year investment horizon. If you're liking this content so far, please consider subscribing and liking the video. Now let's continue. 4. Consider your super fund exposure. According to MoneySmart, a government website, your choice of superannuation should be based on your risk tolerance, age, and how long it will be until you can access the funds. For example, many Australian employees in their 20s and 30s choose growth superannuation funds with substantial exposure to shares, assuming they will have plenty of time to make up for any losses if the stock market falls before retirement. However, a balanced or conservative super fund may be a better option if you're approaching retirement age due to the additional protection they provide against a stock market downturn. A conservative fund's investment mix typically consists of 30% stocks and real estate and 70% fixed interest and cash. On the other hand, a growth fund would invest around 85% of its total assets in stocks and real estate, with the remaining 15% in bonds and cash. In the case of a high growth option, you may be exposed to the entirety of your capital in the form of shares. Consult with your financial planner to determine what is best for your situation. 5. Other tips for protecting your portfolio. You can avoid a loss by selling your shares at a price using a stop loss or limit order. A stop loss order is an order to sell shares at or below a specific price, the stop price. For example, if you bought 100 pence in shares and wanted to protect yourself from losing 10% of your investment, you could set a stop loss order at £90. The acquisition of money. Cash investments provide the most protection against the ebb and flow of the stock market. As Australia's Big Four banks have passed on rate increases to Australian mortgage holders, pressure is mounting on them to raise interest rates on savings products, which are currently low and generally below the level of inflation. Well, that's all for today's video. Tell us in the comment section how this one was. I hope that you found this video interesting, and you can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.